Gold isn't being bid right now, it's being repriced, and the people arguing about who's buying are staring at the wrong tape. There's a force in this market that wants you to believe the move is just emotion, just fear, just headline chasing. But the mechanism underneath is colder than that. It's math, it's positioning, it's the plumbing of paper gold colliding with the slow, relentless gravity of physical reserve demand. And before we're done, you're going to know exactly what level matters, what the next 2 weeks are likely to do to price discovery, and the one checklist that tells you whether this is a controlled climb or the kind of squeeze that turns dips into traps. Because the question, central banks versus funds, sounds simple until you see how gold actually moves. Central banks buy like glaciers, slow, deliberate, size that doesn't flinch. Funds buy like lightning, fast, levered, mark to market every second. And here's the uncomfortable truth. The chart you watch every day is mostly set by lightning. The marginal price, the price that prints, usually comes from futures, options, and dealer hedging, not a pallet of bars moving into a vault. That doesn't mean the glacier doesn't matter. It means the glacier changes the landscape, and the lightning decides where the fire starts. Look at where we are right now. Spot gold has been pressing up around the $5,000 neighborhood per ounce, flirting with that psychological round number like it's testing a door that's been locked for years. We've seen the market swing through the high 4,600s recently, and then drive back toward $4,900 and above, with prints showing the upper 4,900s. That's not a sleepy grind. That's a market trying to establish a new reference point. And when a market does that near a round number, everything gets louder. Headlines, hot takes, conspiracy-adjacent narratives, and the worst one of all, certainty. But that's not the part that matters. The part that matters is the character of the move. A repricing toward a major number forces every participant to rerun their risk models. It forces dealers to adjust hedges. It forces funds to decide whether they're underexposed or late. It forces producers and refiners and jewelers to revisit hedging. It forces central banks quietly to compare the cost of waiting versus the cost of being front-run by the next wave of demand. And that's where the real pressure starts. The official story wants to make this a simple morality play. Investors are scared, so they buy gold. And sure, fear is always around the edges. But the trading reality looks more like a tug of war between positioning stress and long horizon reserve rotation. You can feel it in how quickly price reacts to calendar events. You can feel it in how dips are treated. You can feel it in what happens when the market gets close to key strikes in the options chain. And if you've ever watched gold snap higher in a way that makes no sense on the headline of the day, that's the tell. Not manipulation in the cartoon sense, mechanics in the professional sense, incentives, balance sheets, risk limits, hedging math. So let's get the hidden detail on the table, because it reframes everything. The biggest buyer does not have to be the buyer that moves price. The buyer that moves price is the buyer that changes the hedging math. Funds can do that in an afternoon. Dealers can be forced to do it in minutes. Central banks don't do it fast, but their presence in the background changes what other participants believe will happen on weakness. And that belief is fuel. Here's how funds can buy gold without taking a single bar. Most of the time, they're buying exposure. That exposure runs through futures contracts, options, and in many cases, ETFs that themselves lean on an ecosystem of authorized participants, creation and redemption baskets, and the underlying wholesale market that sources metal or hedges exposure. A fund that buys futures is taking a position that is marked every day. Margin changes, volatility changes, and as volatility changes, the capital required to hold that position changes. That matters because it creates forced behavior. When the market moves fast, it can trigger mechanical buying or selling, not because someone changed their mind, but because someone's risk model changed the rules. Now add options. Options are where the market becomes a feedback loop. When traders buy calls, dealers often end up short those calls. Short calls have positive delta to the buyer, negative delta to the seller. Dealers hedge that delta by buying futures as price rises and selling as price falls. That's delta hedging. And the intensity of that hedging depends on gamma, how quickly delta changes as price moves. When gamma is high near key strikes and expiries, a move can accelerate itself. Price rises, dealers buy to hedge. The buying pushes price higher, dealers have to buy more. Price falls, hedges come off, selling pushes price lower. It's not a conspiracy, it's a reflex. And once that reflex kicks in near a psychological level, the market stops feeling like an auction and starts feeling like a machine. But that still doesn't answer the rotation question. So let AS define the two demand streams in a way that actually matches how the market behaves. Central bank demand is structural. It's about reserves, credibility, and geopolitical risk management. It's not about weekly charts. Central banks aren't chasing candles. They're managing a portfolio of national optionality. Over the past few years, official sector buying has been unusually strong, including years where global central banks added on the order of 1,000 tons to reserves, according to industry tracking. That matters because it signals a persistent reallocation away from pure reliance on foreign currency assets and toward an asset that isn't tee up someone else's liability. That's the glacier. Fund demand is cyclical and reflexive. Funds are influenced by rate expectations, inflation expectations, the dollar, volatility regimes, and performance pressure. A fund can be underweight gold for months, then suddenly can afford to be underweight for one more week because the benchmark is moving and their clients are watching. Funds are also the ones who express views quickly using leverage, and leverage is what turns a narrative into a price event. That's the lightning. So who's driving it? In the short run, funds and dealer hedging drive the steering wheel. In the long run, central banks are part of the engine that keeps the bid alive when every dip would otherwise look like an opportunity to fade. And the rotation, the shift in dominance, happens when one of those flows changes speed or visibility. Right now, the market is acting like the fast money layer is loud again, while the slow money layer keeps making the downside feel crowded. You can see that loud layer in positioning. The weekly futures positioning data, think of it as the market S confession, has shown speculative net long exposure rising recently, which is consistent with funds stepping in and adding longs as the rally extends. When specs add length into strength, that can be bullish in the moment and fragile later, depending on how crowded it gets. It's like piling people onto a narrow bridge. The bridge holds until it doesn't, and that's why the next part matters. Because the calendar is the catalyst. This is not a timeless story, it's a right now story. Late January compresses multiple pressure points into a narrow window, a major Federal Reserve meeting on January 27th to 28th, month-end rebalancing behavior, and key options expiries in the gold complex that can concentrate gamma around certain strikes. When those line up, liquidity can thin, spreads can widen, and the market becomes more sensitive to flows that would normally be absorbed quietly. And if you've been around long enough, you know what happens when a market sensitive to flows gets surprised. It doesn't drift, it gaps. Here's why month-end matters even if you don't care about calendar trivia. Big portfolios have rules. Some rebalance, some target volatility, some hedge currency exposure at month-end. Some adjust commodity exposure based on risk budgets and correlations. And when gold is moving sharply into month-end, it can force mechanical adjustments, either selling to lock risk down or buying because the portfolio is underhedged against the exact risks that are rising. It's not emotional, it's procedural. But procedural flows move markets because they're reliable and sizable. Now stack that with the Fed. Even if the Fed does nothing, the market trades the path. The words, the tone, the dots, the risk that policy credibility is eroding. Gold doesn't need rates to fall to rally. Gold needs the market to doubt what rates mean in real terms, or to doubt the stability of the policy framework, or to price a future where financial conditions become politically constrained. When investors sense that real purchasing power is on a treadmill, always running, never arriving, gold becomes less of a trade and more of a statement. And statements attract capital. Add geopolitics and trade stress, and the narrative layer grows teeth. Tariff threats, supply chain friction, currency anxieties, these aren't just headlines. They're inputs into global reserve management and corporate procurement decisions. They influence how much inventory feels safe. They influence where money wants to park when trust gets expensive. And when trust gets expensive, gold gets cheaper by comparison. But again, don't get lost in headlines. Watch the mechanisms. Let's build the proof stack, because one argument is never enough in markets. You need layers. First layer, chart structure and level psychology. Around 5,000 is not just a number, it's a magnet for options strikes. It's a magnet for media. It's a magnet for risk managers who hate being surprised. When price approaches that number, you often see two behaviors. Momentum buyers press, and sellers appear because they assume round number means rejection. The conflict creates volatility, and volatility is what dealers hedge. So a simple fight over a number becomes a hedge-driven event. Second layer, futures and options participation. When price rises with strong volume and open interest dynamics consistent with new positioning, it signals active engagement, not just passive drift. That's important because active engagement is what creates feedback loops. Passive demand doesn't panic, active demand can. Third layer, ETF flow behavior as the public on-ramp. ETFs are where a lot of private sector demand expresses itself, from retail to institutions who want exposure without futures infrastructure. When ETF interest is persistent, it tells you dips are being treated like inventory, not danger. It also tells you the private sector leg of demand is not just talk, it is implemented. And that matters because it competes with physical availability at the margin and reinforces the sense that gold is being adopted as a strategic hedge, not just a trade. Fourth layer, the central bank floor bid. Official sector buying doesn't show up as a day trader's candle, but it changes the narrative of what fair value could be in a world of reserve diversification. When central banks add consistently, it signals that they view gold as insurance against a specific class of risk: geopolitical fragmentation, sanctions risk, and the weaponization of payment rails. That isn't a conspiracy, it's openly discussed risk management, and it's the kind of demand that doesn't care if the RSI is overbought. Fifth layer, the paper versus physical tension. This is where people get loud, but we're going to stay finance literate. Physical stress shows up in the cost and speed of access, not in a tweet. It shows up in wholesale premiums, in lease and swap dynamics, and how easily arbitrage can pull metal from one region to another, and in whether the market is paying you to hold inventory or charging you. When physical is tight, the market structure starts whispering things the headline tape can't see. And when the structure whispers, smart money listens. Because if physical demand and financing conditions are tight at the same time that paper positioning is building, you can get the kind of move that looks irrational right up until it's obvious. Sixth layer, macro regime. Gold's relationship with real yields and the dollar isn't a simple lever anymore. In some regimes, gold rises because real yields fall. In others, gold rises even as yields stay firm, because the market is pricing a future where fiscal stress and policy constraints matter more than the current rate setting. That's a subtle shift. It's not about today's yield, it's about tomorrow's credibility. And that S, the kind of macro that central banks feel in their bones and funds, feel in their performance reports. Now here's the pivot. The rotation question isn't who is buying more. The rotation question is whose buying is currently dominating the price path. And those are not the same thing. Central banks can be net buyers while the price chops because funds are selling futures. Funds can be net buyers while the price jumps because dealers are forced to hedge. The market is a layered system, and the top layer, the derivatives layer, often decides the short-term direction. So what S, the hidden mechanism that makes this whole setup dangerous and exciting at the same time? It's that round number battles plus expiry timing can flip the options book from stabilizing to destabilizing. In a calm market, dealer hedging can dampen moves. In a stressed market near key strikes, dealer hedging can amplify moves. And if the market pushes through a heavy strike zone, it can trigger forced buying from hedgers and short covering from traders who sold calls or shorted futures against them. That's where paper demand becomes forced demand. And forced demand doesn't negotiate. It pays the price. But don't get hypnotized by the upside. This is where credibility lives, acknowledging how this breaks. There are real counterpoints. One, a sudden spike in real yields or a sharp dollar surge can hit gold hard, especially if positioning is crowded. Two, if ETF flows stall or reverse, it can signal that the private sector bid is less durable than it looked, which can turn dips into deeper pullbacks. Three, if speculative positioning becomes too one-sided, the market becomes vulnerable to a cleansing move, one sharp downdraft that shakes out weak hands and resets the hedging book. And four, policy surprises. Anything that changes the perceived path of rates, liquidity, or geopolitical stability can reprice gold in either direction quickly. And that's not a footnote. That's the core risk. Gold can whip around violently even if the thesis is correct. Price can dump 2 or 3% in a short window, not because the story died, but because the market needed to harvest leverage. That's how this game works. The market doesn't just move to reflect reality. It moves to force behavior. It moves to find who is overextended. And it moves to punish people who confuse trend signal price with every tick must go my way. So here's your psychology shield, because this is where most people get played. Volatility uses 3 emotions against you: urgency, relief, and regret. Urgency makes you buy tops because you think you're missing the real move. Relief makes you sell bottoms because you can't handle the stress of being wrong. Regret makes you chase again at the worst time because you can't stand the story continuing without you. And the market loves that cycle because it transfers conviction from the undisciplined to the disciplined. You beat that cycle by separating signal from noise. Signal is structure. Higher highs holding, key levels respected, dips bought with intent, and positioning that isn't collapsing at the first sign of trouble. Noise is the intraday whip that exists to test your resolve and your sizing. If you size correctly, noise is annoying. If you size incorrectly, noise becomes existential. And when noise becomes existential, you become liquidity for someone else. Now let's get practical about what comes next, because this is where you earn trust. 2 scenarios, always 2. If you only see one path, you're not analyzing, you're campaigning. Scenario 1 is the controlled pullback and retest. Gold tags up toward that 5,000 neighborhood, gets rejected or stalls, then pulls back into a prior breakout zone. Think mid to high $4,800 or a nearby support shelf, where buyers prove they're real. In this scenario, the market is digesting gains, dealers are resetting their hedges, weak longs are being shaken, and the trend stays intact if support holds. Confirmation looks like dips that get bought quickly, downside momentum that fades, and price stabilizing without violent liquidation. Weakening signals look like repeated failures to reclaim key levels, ETF interest cooling, and positioning unwinding in a way that looks like rush for the exits. Scenario 2 is the continuation squeeze with gap risk. Gold doesn't give you the polite retest. It presses, breaks, and runs through the round number as the options book flips and hedgers chase. In this scenario, you see sharper intraday bursts, thinner liquidity, and a market that feels like it's climbing a staircase where some steps are missing. Confirmation looks like clean acceptance above the psychological level, momentum that doesn't immediately fade, and the kind of price action where dips are shallow and get bought before you can blink. The warning sign is also obvious. If you get a big up move and then a fast reversal back under the level, that's the market telling you the break didn't take. And the unwind can be violent because the same hedging flows that pushed it up can pull it down when they unwind. So what invalidates the broader thesis that there's a demand rotation supporting gold? A decisive breakdown that holds below major support zones while ETF interest fades and positioning unwinds aggressively, especially if it coincides with a regime shift toward tighter real conditions and a stronger dollar. Invalidation is not one red day, or invalidation is a structural change where the bid disappears and stays gone. The market will try to fake you out. That's the job. You're not looking for perfection. You're looking for whether the market is still being supported by the mechanisms we've talked about. And now, let's answer the title cleanly, with no drama. Who's driving it? Right now, the steering wheel is in the hands of funds and the derivatives complex, futures positioning, option strikes, dealer hedging, and the calendar. That's what makes the market jumpy and fast. But the road this car is on, the long path that keeps gold supported even when it gets expensive, has been shaped by central bank behavior and reserve management logic. Central banks don't need to be the daily buyer to be the daily influence. Their behavior changes what other participants believe will happen over time. And belief changes positioning. Positioning changes hedging. Hedging changes price. That's the chain. Here's the final detail I want you watching, because it's just the metric that cuts through the noise. Watch how gold behaves after it touches the big number. Not the touch, the aftermath. If gold tags that zone and then holds its pullbacks above prior support, it's telling you demand is sticky. If it tags that zone and then slices back down through support with speed, it's telling you leverage was doing more of the work than you thought. And that difference matters more than any headline, because it tells you whether the market is building a base under a new price regime or just stretching a rubber band. And remember the incentive structure. Institutions Don T need to suppress anything in a comic book way to make this trade hard. All they need is for liquidity to thin and volatility to spike, so that your emotions do the selling for them. That's how volatility gets used against you. It manufactures certainty on the way up and panic on the way down. And the people who win are the ones who treat both as information, not instructions. If you're looking for the clean weekly roadmap, here it is. Going into this week and next, the market is compressing around major catalysts: Fed communication risk, month-end positioning behavior, and options-related hedging pressure. In that window, expect sharper moves than normal. Expect fakeouts. Expect sudden bursts that feel like they came from nowhere. That doesn't mean the story is fake. It means the plumbing is active. Your job is to watch for confirmation. Does strength hold? Do pullbacks get defended? Does price accept above key psychological zones or reject and fail repeatedly? That's it. Simple, not easy. And if you were a part of the metals crowd that is tired of being told every move is either a bubble or a conspiracy, here is the identity you can anchor to. You are not here to be entertained by narratives. You're here to understand the machine. You're here to recognize when a market is being driven by slow structural allocation versus fast reflexive positioning, and you're here to survive the volatility long enough to let the signal pay you. If that's you, stay close to people who think in mechanisms, not vibes. Keep your risk defined. Keep your time horizon honest. And keep your eyes on the one thing that never lies for long. What price does after the level, not what it did at the level. When metal is tight, lead times become a topic. When metal is abundant, buyers shop price. When metal is tight, buyers shop availability. And when silver is both an industrial input and an investment asset, the market can shift from price discovery to availability discovery fast. And that's where a lot of people get trapped because they keep treating it like a slow-moving macro trade instead of a supply chain with deadlines. Now let's talk about why tightening in silver is uniquely powerful. Silver is not just mined as silver. A large portion of global silver supply is a byproduct of mining for other metals like lead, zinc, copper, and gold. That matters because it means silver supply doesn't ramp neatly when silver price rises. If the primary driver mines aren't expanding, or if base metal demand changes, silver supply can be sticky. You can't just say, price is up, so supply will flood in next week. Mining lead times are long. Permitting is long. Processing capacity is real. Refining and fabrication capacity has constraints. Even recycling responds with delays and depends on the pipeline of scrap material. So if demand changes quickly, the supply response is not immediate. That's the supply chain veto. And it nombre exactly why shorting silver based on it at S gone up too much is so dangerous during a tightening phase, because the market doesn't care about your feeling. It cares about delivery. It cares about hedges. It cares about getting bars where they need to be. And if the marginal bar is scarce, price can stay irrational longer than a leveraged short can stay solvent. But here's where we keep it finance credible and not cartoonish. People love to throw around the word manipulation. The more accurate frame is incentives and market structure. Large participants hedge. They manage inventories. They manage exposures across OTC and futures. They manage funding. And they often prefer stable prices because stability reduces risk and reduces margin volatility. When prices jump, it stresses risk systems. That doesn't mean someone is flipping a villain switch. It means the system resists volatility. It tries to damp it. It widens spreads. It raises margin. It reduces liquidity. And that resistance can look like suppression, especially in a thin market. But the important takeaway is not moral outrage. The important takeaway is when resistance shows up and price keeps going anyway, the underlying pressure is stronger than the damping mechanisms. And that's a tell. Because if the usual dampers, liquidity provision, short selling, roll behavior, can't stop the move, then the market is not trading normally. It's repricing a constraint. Now, you want the hidden detail in practical form? Here it is. In silver, the conflict between paper pricing and physical availability often surfaces first in spreads and deliverable categories, not in the headline spot price. Spot can move because futures move. Futures can move because of positioning, but spreads and deliverable inventory don't lie as easily because they retether to settlement and sourcing. When nearby spreads firm, it's telling you immediate access is valued. When deliverable categories shrink, it's telling you fewer holders are volunteering metal at current prices. When ETFs absorb metal, it's telling you investment demand is pulling supply out of circulation. Stack those together, and suddenly the $100 headline is not the story. The story is that the system is being asked right now to provide metal into multiple channels simultaneously, investment, industrial, and settlement, while the supply chain can't instantly respond. And that's why this move isn't emotion, it's math. But here comes the trap for viewers, and you need to hear this clearly. Even when the thesis is correct, price can whip around violently. Silver can spike, then dump, then spike again, all while the underlying tightening remains. That's not a contradiction.